Happy Fed Day out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, November 2nd, 2022. We got FOMC at 2 o'clock, Fed presser at 2:30 with Jay Powell. We'll see what he has to say about the pivot we're all speculating about. But before we even get that, at 10 a.m. this morning, a lot of you may not know, but the Treasury Department, Janet Yellen, has our press conference associated with the quarterly refunding announcement that we received on Monday. Markets are going to be looking for any signs of Treasury buybacks, which would be very bullish for asset markets from the perspective of removing duration risk out of the market and replacing it with lower duration securities, which allows investors to go flow further out on the risk curve and take more risk. So we'll see. That would also actually drain that reverse repo facility balance to the extent that we see incremental supply of T-bills in lieu of coupons. So definitely looking for some guidance there. It's our belief, based on the guidance we've gotten out of both Chair Powell and Yellen, that they're sort of, their resolve to continue to fight inflation is actually quite strong still, and the willingness to bail out asset markets, to bail out underperforming investors who were paying attention a year ago when the policy tide started to change. I don't think they have I think they don't have a very high tolerance for a pivot right now. I think it's very I think it's relatively early in that process. Getting to our economic relief spotlight. So the latest batch of key high frequency data from across the global economy were confirming of a couple of themes we've been talking about all summer, really for a while now, which is the U.S. economy is booming with all caps on a coincident to lagging indicator basis, and then American exceptionalism persists, not just U.S. But also our neighboring economies as well, and that both American economies and Asian economies are demonstrably outperforming their European counterparts. So just give you a quick brief rundown of the data, particularly with respect to this booming U.S. economy here. So, and again, we're talking about coincident to lagging indicators, obviously leading indicators, and I think we have some of the best in terms of our models projecting the next 12 months for not just the U.S. economy and every economy. We don't just do U.S. here. We actually run sophisticated models for every economy in the world in terms of projecting growth and inflation. But just on the coincident to lagging indicator nature of the strength in the U.S. economy, just running down the list, total job openings increased yesterday by the fastest pace since March in September, and it dragged that total job openings to total unemployed ratio back up to 1.9, which is right around the all-time high, or just shy of the all-time high. The private sector quits rate came in at 50 basis points above its long-term average, which signals a still tight labor market. The 12.6 three-month annualized growth rate of non-residential construction spending is nearly 3 times its long-term average. The 46.4% three-month annualized growth rate of auto sales here in the U.S. economy compares to a long-term average of 2%. 46.4% in the month of this is October print versus 2%. Again, people are missing these data points. The ADP private payrolls number came in this morning, beat consensus expectations, and accelerated to a 3-month high at 239K month over month. The 3-month SAR, the 3-month annualized rate, is 2.2%, and that is that's still north of the long-term average there. So again, the economy is slowing. It's going to continue to slow, and eventually will wind up in recession. At least that's our baseline expectation. However, today, over the next few months, we're still talking about booming U.S. economy on a coincident to lagging indicator basis. And what does that mean? That means the probability that inflation, particularly on the core inflation side, that is being primarily driven by the reduction in supply and labor and the associated increase in wages, that's likely to continue. Core services ex shelter is the number one indicator you should be watching, alongside median CPI and sticky CPI, which includes shelter. Those, in our opinion, are the 3 things that Jay Powell are going to be anchoring on the CPI front. We get a couple more CPI data points before the December Fed meeting, and then we'll also kind of looking at the core PCE data as well. Trimming PCE, something Fed has cited as well. So we are very much still in the same boat when it comes to inflationary pressure. Again, it's going to come down. But again, it's not going to come down nearly as fast as those who may have positioned already for the Fed pivot need it to. So just be careful out there. And we'll see. Again, this is our U.S. monetary policy is being ran by a group of people. And so if they change their mind on something, we have to be ready and willing to change, irrespective of what the data says. We're just trying to say, hey, the data says X, and based on the guidance, you should expect Y. That's all we really can do as investors. Shifting gears, looking at my Longbow dashboard here, going down global macro. So as I mentioned yesterday, very similar setup to yesterday in terms of just scrolling down. Everything's kind of in the middle of the range with the exception of industrial metals down here. They've been hodling out at the low end of their range for a while now, just kind of flagging and sagging. And the reason for that, in our opinion, is the sort of renewed commitment to zero COVID out of President Xi. We think that's something that is going to continue to weigh on industrial metals and grow more growth oriented commodity prices as well. Kind of not, like I said, everything's kind of in the middle of the range, playing wait and see here on the Fed pivot. We're going to see some fireworks if we get explosive commentary in either direction, to the potential to the hawkish side or to the dovish side. We happen to think the modal outcome is that they don't really say anything that provides a hell of a lot of confirmation or gives really definitive answer on what way to lean as an investor. Because again, we have two CPI reports between now and the December 14th Fed meeting. We have we have two jobs reports as well. And then we have a PCE report that contains core PCE. And then of course we'll get a couple of, University of Michigan 5 to 10 year forward median inflation expectations readings as well. So this is a Fed that can just hike, say nothing in the press conference and move on, because again, we got a lot of data to digest between now and the next meeting. So it's our belief that we're not going to get what we need out of the Fed today, and that potentially sets the markets up for an unhealthy period. Just given where the net liquidity fundamentals are telling the markets to go. Just shifting gears and kind of concluding with what's most overbought and oversold in my broader global macro ETF list. About 300 factor exposures here across, representing each 300 ETFs here representing individual factor exposures. Nothing's particularly overbought. Again, sorting this by odds. Nothing's particularly oversold as well. The one thing I call out is you have some sort of fixed income type securities here at the bottom. SHV, that's short-term treasury bonds, T-bills, which makes sense. Fed's about to hike 75 basis points here. The yield's going to continue to rise on those types of instruments. And then just sort of looking for something for those of you who are junkies that want to maybe play some days to expiry call options on things that might rip if the Fed says anything dovish. Palladium, that's one thing that's actually kind of getting towards the lower boundary of the range there. It's got 10% plus upside, or nearly 11% upside. Futures would not play there, but uranium has actually got decent upside downside in its range there as well. So I know a lot of folks love the uranium story long term. That'd be something to kind of think about from the perspective of trying to play some YOLO call option. Again, we're not telling you to go do that. Again, I don't think that's an appropriate thing to do given our fundamental views. But to the extent that you certainly want to kind of wing it, this is what the platform is designed to do. It's to pull in the data that you need to analyze financial markets at a professional level and allow you to give you the kind of clean, actionable signals to make decisions. It's not telling you what decision to make. It's just giving you all the information you need to make good, consistent decisions as a risk manager in global financial markets. So hopefully this is helpful. Catch you back here tomorrow, same time. We'll have some very interesting thoughts to follow up on today's QRA and FOMC meetings tomorrow. So cheers. Have a great day out there.